I'm Charles Payne, and you're watching Making Money, Secrets of Silicon Valley's billion-dollar businesses, also known as unicorns. How do these companies go from zero to millions of users and subscribers in a flash? They steal them. Growth hacking and more from the CEO of the hottest IPO of 2015 later in the show. This matters to you because over the next year, individual investors are going to be seduced into buying these hot IPOs that have already gone through the roof from private markets. Now, some are going to be worth chasing, but a whole lot are going to be disasters. In fact, case in point today, the takeover you didn't hear about, but perhaps the biggest cautionary tale for investors. Hot topic, paying $17.50 for GeekNet, up 122% premium. Sounds great? Not necessarily. You see, GeekNet was once SourceForce, and before that, VA Linux. Sounds familiar, right? Well, it should. You know why? The company still holds the record for the biggest first-day trading move in history. The IPO was 30. The first trade was $299. It hit $330, closed at $239, up 698% in one day. Today, with that big premium, it's still sold for 93% less than that first day of trading. So let's find out how you can avoid a similar fate. All right, guys, I know everybody here kind of remembers those good go-go days. Let's meet our investment pros. We got a new face with us this afternoon. Arben Kryeziu is CEO of Code Red and founder of Kryeziu Ventures. Did I come close enough?
You're close enough.
Close enough. Hey, you know this name, Christopher Sace. His friends call him Versace. But anyway, thematic growth portfolio manager at Fabian Wealth Strategies. Jim Frischling, everybody knows him, president of New Oak Capital. Hillary Kramer's with us, president and chief investment officer at A&G Capital. And, of course, Matt McCall, founder and president of Payne Financial Group. Let's do it, guys. Let's dig into the first real deal. Now, Arben, it seems like every other day another company comes out with another billion-dollar valuation in the private markets. Mark Cuban maybe sent up the first yellow red flag or flare, if you will. How worried should people be? Is this a gigantic bubble somehow?
I don't think so. I think we should learn about what happened in 2000, and the ecosystem was not ready at that time to actually adopt technology. Now you have 4 to 5 screens in every household. You got TVs, you got desktops, tablets, you got iPhones and smartphones. You have now watches. And that means there's a massive appetite in the ecosystem to actually hunger for technology.
Yeah, I get your point, because I remember when we first put in fiber optics in our office, and we were doing some things on the web. Average people couldn't get it on their TV or on their computers. Foreigners had it or whatever, and it was kind of spotty. We were definitely years early. What about some of these secrets? How do these companies, you and I were talking about this, growth hacking. Explain to the audience how all of a sudden these companies instantly get so many subscribers or have access to so many people.
Well, they identify where their clients are, and instead of actually using traditional methods like marketing, they actually identify the river that's constantly flowing. Now, so what that means is that, for example, Airbnb, the way they actually were able to get the volume of listings, they actually stole it from Craigslist, or copied it from Craigslist and VRBO, and then all of a sudden they had a massive, listing volume. They presented that data much better, and guess what?
Is this the secret, though? I mean, is this like the open secret in Silicon Valley? You get enough money, you go and you borrow someone's list, and you're up and running?
The idea is adoption, for you to actually identify growth patterns. And if you don't have a growth hacker in your team right now in Silicon Valley, you can't even raise money.
Wow, that's absolutely amazing. Now, I'll ask the market guys, and I'll start with you, Hillary. Now, for me, there's something unseemly about the idea that Uber, for instance, and we're going to talk more in detail about it, but just any company could, let's say, be worth $500 million, then $1 billion, then $3 billion, then $10 billion, and then by the time they go public and they give us a shot at it, or the viewers, hey, it could be yours for $90 billion. It didn't always work that way. There was a time when people got involved a lot earlier and were able to enjoy the ramp up.
Right, but the world has changed so much, as we're talking about in Silicon Valley, with all of these early rounds of investors that keep raising the valuation. So you have an Uber, which was $45 billion. Now we're at $60 billion. And for us to make money, the only way as an individual investor anyone will make money is if Uber only comes public with maybe 3% of the value, maybe $1.8 billion. So the float has to be small. I don't understand,
though. Even if the float is small, the market cap, though, would be the same, though. In other words,
but it's
if it went public at $90 billion, even if they only sold 100 shares, it would still be someone's going to be paying up for this thing.
Right, because you always have some people who are all going to invest in IPOs. All over the world, you have that interest. But when it comes to Uber, it's very interesting. There were plenty of other Ubers out there. There have been so many companies like Uber, but Uber did exactly what Arben is saying, which is take the clients and the customers and figure out ways to convert everyone over to themselves and get scale.
Arben talked about more screens at home, the pods, the watches now, the iPhones and whatnot. The fact is the private market has matured a lot as well. So you're making a very good point that there are so many rounds of financing and the valuation is shooting up before it goes public and the retail investors get a shot. But the fact is, I also say a lot of mistakes and a lot of companies that probably never should have gone public in the original crash. They went public because they put a .com in their name. They're not going to be able to go public because they're not going to get the private funding.
So you're saying
there's a yin and a yang here.
They're better vetted.
They're far better vetted, but you're right that a lot of the value potentially has been taken off the table. But look at Facebook. People who could have who bought it in the open market when it went public actually would have done pretty well. So it doesn't take out all the value, but it does take out a lot of it, I guess, in the private market.
Chris wrote an article on Shopify, right? Just last week. You seem pretty bullish on it. Now, of course, Etsy, which went public a month ago, has been an unmitigated disaster for anyone who bought it that day at the high.
That's right.
What's the difference? Why does one work and one doesn't?
Well, to me, Etsy is a portal where people can sell things, right? So you can only buy what they have at the moment. Shopify, on the other hand, it's an enabling platform that lets small, medium-sized businesses put their wares on the web. So one's enabling, one's just a portal. Kind of like, and I compare Etsy to Groupon, where with Groupon, it really depends on what they have at that moment.
Right.
And
so there are limitations. By the way, limitations they put on themselves, I think, which are a little bit onerous, but that's the internal problem. All right, so here's the thing, Matt. You've got all these private sector companies. If something went wrong, if one of these companies couldn't raise money, if somehow there was a panic on the private market, I don't know how it would play out, but how would it affect the public market?
I don't think it would be much effect. It may be very short one-off, maybe affect another company that's related to them, a very niche sector. But if you look at the valuations of just the publicly traded companies, the NASDAQ forward PE, the next 12 months looking out, is less than 20. We're not at bubble valuations. It's very tough to value the private companies, so they may be at bubble valuations, as Mark Cuban said, and a lot of other people agree with him. But when it comes to the public ones, when you're in a public market, it's very liquid. We determine, the public, the hedge funds determine the valuation of that company. So I'm not as concerned when private ones are not very liquid. Right. You're going to have astronomical valuations.
I tell you, it's just a little problematic when every day there's a new billion-dollar company out there. All right, guys, we do have